Hey. How y'all doing this evening? Y'all give me a second because my glass is filthy. I need to be able to see. Hey Donna, hey Deidre. Girl, I gotta get her all up on the screen. Hey Carla. Hey Carla. How y'all doing this evening? Hey, mobile home mommy. What's going on? What's good? All right, so from the group, what I kept hearing, hey Joy, what I kept hearing is y'all want to know how we fund these fix and flip deals. And I know there's a lot of misconceptions about hard money loans, so I'm gonna break all that down for you real quick because it's not as scary or complicated as you might think. Actually, I'd rather fund a deal for a hard money loan than to get a mortgage for my primary residence any day of the week. And I'm going to tell you why. So first let's start with what is hard money? What is a hard money loan? So when you are trying to purchase a primary residence, where are you going to go to get a loan? You're going to go to a mortgage lender, you're going to go to a bank, you're going to go to a traditional money source, right? And they're going to get all in your financials. They want 2 years of tax returns. They want 3 to 6 months of bank statements. They want to know where your down payment is coming from. They want proof of every income source that you have. They're going to get all in your business, okay? Pulling your credit reports and asking all kinds of questions about, okay, looks like you spent $200 on this last month. What was that, right? So it's a very involved process. When you're trying to fund an investment deal, if you go to a traditional bank to get funding for an investment deal, especially if you are a new real estate investor, you will find it extremely difficult if they will do business with you at all. So that being said, hard money has its place as a lending source for real estate investors. It is designed for non-owner occupied properties, right? So these are properties you're not going to live in it. I don't care if it's a duplex. You can't live on that property with a hard money loan. That is one of their criteria. Okay. But they are going to allow you to get approved for a loan without all those hassles that I talked about for the most part. Now, I'm talking specifically about fix and flip short-term loans. And when I say short-term, these are going to be loans with a term of 1 year or less. Okay. There are other loan products for buy and holds. That's not really what I wanted to talk about today. I do, and for y'all that don't know, I am a hard money loan broker. So I am partnered with these different lenders for hard money loan products. So can I get you a loan for a buy and hold? Absolutely. It's more involved than what I'm about to break down for you right now, but absolutely we can get you a loan product for a 5-year, 10-year, 15-year, 30-year term for a buy and hold. What I'm talking about right now is they call them bridge loans also, but it's a short-term loan for the purpose of purchasing and rehabbing these properties. Okay, so let's talk about what's the difference between a hard money loan and a traditional loan. So you're not going to get 3% with a hard money loan. So let's just put that out there first and foremost, because it is a risky product. So if you are getting a loan for your primary residence, you're going to live there, right? So you're not going to want to lose your home. You're not going to want to ruin your credit. You're going to try to make your mortgage payment by any means necessary, right? When you have an investment product, you're not living there. in an investment property. You're not living there. So if you lose that home, you're probably not losing as much. You're still losing, but you're not losing as much as if you were living there, right? So there's additional risk that comes along with that. And y'all know in the world of finance, risk means higher rates, right? So they want to be compensated for the risk involved with giving you a loan that you could more likely default on than if it were your primary residence. Okay, so just know it's a higher risk, which means you're going to have to pay more for that money. It is more expensive to get a hard money loan. So, yes, your interest rate will be higher. And for a fix and flip loan, those are typically going to be somewhere between 6 and 13%. As you get more experienced, if you put down more money, if there is less risk involved, you get better terms, right? So experience mitigates risk in the world of hard money loans. They like to see that you know what you're doing. And if you have experience doing this successfully, that is enough to give you that check mark for experience. Okay. So that being said, know that the rates will be higher and your origination points will be higher. So if you were buying a primary residence, you're going to pay to close on that loan. Those are your origination fees for getting that loan. For hard money loans, that's typically going to be in the range of 4 to 4.5%, 4.5 points. And basically you can think of it like a percentage, but 4.5 points, 4 to 4.5 points is what you're going to pay for origination fees for hard money loans. You factor that into your project. That's a cost of doing business. So if you're evaluating a deal and you know that you're going to have to use hard money, factor that in. Okay. All right. So the next thing that I wanted to talk about again was the term. So the 12-month is a short-term product versus with a primary mortgage, you're going to have 15 or 30-year term. It is designed for you to get in, improve that property, and sell it. If you want to use this type of funding for a buy and hold, you absolutely can. And here's how you do that. So I recently shared something in the group, maybe about a month or so ago, about BRRRR investing, BRRRR. And under that scenario, you're buying a property, you're renovating it, you're renting it out to a tenant, then you're refinancing it and taking the money from your refi and then repeating that process by buying another property, right? So you can do a modified version of that for a fix and flip using a hard money loan. If we're talking about a fix and flip hard money loan. So you could get that hard money loan and it's going to include the cost to purchase the property and the renovation budget. You can then fix that property up. And after you have fixed it up and put a tenant in it, you can go and refinance that property, right? So now you've refinanced because you've stabilized the property. That means that the property is livable and you've got a cash flowing rental property, right? You've got a tenant in it that is paying you monthly rent. And in that scenario, you've stabilized the property. You may be able to go to a traditional lender to get a mortgage at that time, right? So it's not the same as if you were trying to buy a turnkey buy and hold property. You've already demonstrated that this is a cash flowing rental at that point. It's a much easier conversation with a traditional lender. Or you can refinance out of that fix and flip hard money loan into a buy and hold hard money loan. And actually the rates are better for a buy and hold hard money loan than for the fix and flip loan. Again, because it is designed for a more stabilized property that's already been improved. All right, so hopefully that makes sense what I'm saying. So if you are trying to fix and flip, let's talk about what they're going to ask for to get you qualified for that loan. So are they going to pull your credit? Yes. Are they going to run a background, a LexisNexis background check on you? Yes. They just want to make sure, you're not someone who is known for fraud or that kind of thing. That really is all that they're looking for. Credit score requirements for this lender that I absolutely love, the one that we use personally, I can get you qualified with a hard money loan at 600 credit score. So it's very easy to qualify for it. What they're more concerned about, and you have to close in a business name, again, because it has to be non-owner occupied. So they want to make sure that only businesses are qualifying for these loans. So you have to have either an LLC or an incorporation. You need to have, if you've got an LLC, you need to have your articles of organization, and you need to, what you get when you file for your LLC, they give you that articles of organization from the state. And they're also going to want to see an operating agreement. So a lot of people don't have one of those on hand. It's super easy. You can just do a Google search for operating agreement template for LLC. And if you're a single member LLC, there's a different one than you would use if you were a multi-member LLC. So if it's more than one person on the LLC, you use the multi-member. Okay. So those templates are out there. They're online. Don't worry about it. It's super easy. Really, all that the operating agreement says is who owns it and what percentage ownership does each member of the LLC have. Okay. If you have an incorporation, what you want to have is your articles of incorporation and your bylaws. Okay. So either way, both of those two things are going to be required, just again to show who owns the business. All right. You're going to want to have a purchase and sale agreement, right? So that's standard agreement that says that you agree to buy that property for X price with X closing date. What was the credit score? 600. And that is for any, again, brand new investor, no experience. You can get this type of loan product up to $400,000 with no experience and a 600 credit score. If your deal is going to be more than $400,000, then there's a 660 credit score up to, I think, $750,000. Anything above 750 is going to require a 680 credit score. Okay. But just remember 600, because most people aren't going to have a fix and flip deal upwards of that until you get maybe more experience and you've got a pretty extensive flip. So I think 99% of my clients are under that 400 range. So 600 credit score is what you would need. Okay. So you would need to have a scope of work for your project. Oh, I was talking about your purchase and sale agreement. So once you agree with the seller on a price, you will have an agreement that says that you agree to buy that property at that price by that closing date with whatever other stipulations you have, your standard purchase and sale agreement, right? So once you have your agreement in place, next thing is to get a scope of work. So basically what your scope of work is going to entail is what is it that you're going to do to that property. So if you're going to be renovating the kitchen to bring it up to 2021 standards, upgrading your bathrooms, replacing the HVAC unit, fixing the roof, whatever. You want to kind of give a narrative around what that improvement's going to be. And then you want to break it down for each one of those phases of construction. So I'm talking about phases because if you want to limit your cash out of pocket, because keep in mind with a fix and flip loan, they will cover the purchase price and they will cover the renovation budget. So let's just say your renovation budget is $50,000. When you close on that loan, they're not going to cut you a check for $50,000 like, hey, go ahead and do what you need to do to fix up the property. That's not how hard money loans work. They operate on a draw process. So what does that mean? That means that you are reimbursed after the fact, after the work is done. So could you, complete the entire project and then request your $50,000 on the back end? Absolutely. But you got $50,000 to be able to get that work done? Probably not, unless you just, got it like that. Or even if you do have it like that, that's probably not the smartest way to use your money. And here's how we do it. We break up our scope of work into 5 phases. So if you've got a $50,000 renovation budget, if you break that up into 5 phases, then each phase, I try to map it out so each phase is about $10,000, right? So let's just say the first phase of construction is going to be the kitchen renovation, and that's going to cost $10,000. That means that I got to have $10,000 on hand to be able to get that work done. I got to buy my materials, depending on how you agree to pay your contractor. You may have to pay for your contractor's work during that time frame. I wouldn't, but some people do. The way that we do it is our agreement will say that they will get their first payment when 20% of the work is done. Well, guess what? When 20% of the work is done, I'm applying for my hard money loan draw. So I'm going to get my money from my $10,000 wire from the hard money lender, and then I can pay the contractor. So they getting paid when I get paid. All right. So that was $1 million tip I just gave you. No, I'm just playing. But for real, scope it out so that you can be smart about your money and stretch it out. So once I got that $10,000, I can pay off all my business credit accounts that I use to purchase my materials. I can pay my contractor. And guess what? It's time to start phase 2. And I'm going to use the same money all over again. I'm going to use my business credit accounts to buy my materials. When that phase of construction is done, I'm going to get my hard money loan wire transfer, pay off my credit cards, pay my contractor, start it again for phase 3. See what I'm saying? You keep doing that until your project is done. So it is a reimbursement process, which means you got to have the money on hand to get your project started. All right. So that's the nuts and bolts of how that process works, but you need to map out your scope of work. And I have a template for that on my website. So I would just give it to my contractor. Once you have gotten a few different bids from your contractor, and you've made your selection on who's going to do the work for you, have them fill out the scope of work. Tell them exactly what you need done. And once they've given you the bid, then tell them, hey, I need you to transfer this to the scope of work template so I can submit it to my lender. They're accustomed to doing that. So that's how you will take care of that. They'll need your EIN letter. So always keep that on hand. Credit card authorization form, just saying that you agree for them to pull your credit and run your background check. Copy of your driver's license. That's pretty much about it. That's what they need to qualify you. The other piece, and really this is what they're more concerned about, is the project itself. Is it a profitable project? Does the project make sense? Right? So they're going to want you to be able to articulate what the numbers are. If you don't know your numbers, you're probably not going to get approved for any loan for an investment. And when I say know your numbers, again, the contractor estimate is important. That is a critical piece. You need to know how much it's going to cost to fix that property. But the most important piece is the after repair value. So you will hear people refer to the ARV. The ARV is critically important because that's going to say, what are you going to be able to sell that property for after you fix it up? If you don't know your market, you better have a darn good realtor or somebody that is helping and guiding you, a mentor, a coach, something. Somebody needs to help you understand your market because, even if something is less than a mile away, another property is less than a mile away. If you got a major highway that separates those two properties, I wouldn't consider that a comparable property. So to calculate your ARV, you want to have 3 comparable properties, and you're going to take the average of those 3. That's going to tell you what that property is going to be worth after you fix it up. But when I say comparable, I'm not just looking at square footage. I'm looking at the style of the property. If we're talking, my property is, we call it the subject property. If the subject property is a 2,000 square foot brick ranch and there's a 2,000 square foot 2-story, I wouldn't consider that a comp because the style of those homes is different, right? So I try to look for houses that look like mine. And I look at those properties, and I'm typically going to look at the ones that are the nicest ones. And I'm going to plan to fix my property up to hit the top of the comps. So if I pick 3 properties and the average sale price of those properties, and you're typically only going to look back a year, I try to look within half a mile. If you're, in an area where you haven't had much activity, you can go out a mile, but typically within a half a mile. But I'm looking for those properties that have sold recently. What type of finishes did those properties have? Did they have granite countertops? Did they have hardwood flooring? I want to make my property look like those. And so your construction estimate should be priced with materials that are similar to the materials in those properties, right? You don't want to under improve a property so that it doesn't look like the ones that are at the top of the comps, because you're not going to get what those properties sold for. You don't want to over improve and, put granite countertops in a property where all the other ones, are not nearly as nice. You might have Formica or something like that. Well, guess what? Now you've got a property that is not going to have comps that look like yours. You're not going to be able to sell your property for what you hope to sell it for, even though all things considered, it may be worth it. But comps rule the world in real estate. Okay, so get you 3 good comparable properties. Take the average of those. That's going to give you an idea of what your ARV is. All right. So a lender is not going to want to lend on that full ARV, right? So typically 70% of the ARV is where you want to be able to get approved for this type of loan. So if the after repair value is $300,000, 70% of that is $210,000. That means that they're not going to give you a loan for any more than $210,000. Okay. So that's critically important. Know your numbers. And the tighter those numbers are, the more risk it is, because you could be off with your contractor estimate. You could be off with what the ARV is going to be, right? Because markets change. So if the comps by the time you're done fixing up that property are not at the same level that they were when you started the project, again, that can impact you as well. So the less room that you have in those numbers, the more risk is involved. Okay. Well, congratulations, Emily. All right. So the ARV is important. So no more than 70%. Now, as you get more experience, you can go up to 75% on the loan to ARV amount. Okay. Experience definitely gives you a buffer with hard money. Let's talk about down payment. So if you are a brand new investor, they actually will work with you for these loans. So if you've got 0 to 1 flips, they will cover up to 80% of the cost, which means that the other 20% is your down payment. They want you to have some skin in the game. Okay. At 2 to 3 flips, they will cover up to 85% of the cost. So your down payment is 15%. And if you've got 4+ flips, they will cover 90 to 100%. So you can actually get a 100% loan, but you're probably going to have around 8+ flips under your belt to qualify for that. And there's some criteria for that 100% funding product, but it absolutely can be done. But Most, if you don't meet the criteria for the 100%, if you're experienced, meaning you got 4+ flips, you'll have a 10% down payment. Okay, so we got some questions popping up. Yep, comps is they're critical. Got to get it right. Do you have a target profit on your rehabs? Yeah, so the 30% is really 25 to 30% is really our range that we go after for profit margin. Anything less than that, it kind of gets down to the wire as to whether or not it's really worth it. Another rule of thumb that I like is I want to at least have enough profit to cover what I've put into it. And what I mean by that is if I'm going to do, not considering the purchase price, just the rehab. If I'm going to do a rehab that is extensive, meaning that I'm going to have, let's just say, an $80,000 rehab budget. So this might be, I call it major to a complete rehab. $80,000, I want to have at least $80,000 in profit coming out of that to compensate me for my risk, right? So that's a huge project. So I want to make sure that I'm considering the risk involved with a project that big as well. So those are the two rules of thumb that we use. Hopefully that answers your question, Emily. Hey sis, how you doing, Kristen? Where the money reside? But yes, so you want to consider that when you're looking at different projects. So we talked about, okay, so we didn't talk about minimum loan amount. So the minimum loan amount is $75,000. So that will also take into consideration your rehab budget. So I get people who come to me sometimes with projects where, I'm from Birmingham, so we got a lot of hoods. And in the hood, you might buy a house for $30,000, right? And you might put in $30,000 on the rehab. Well, that's only a $60,000 project. The lenders won't touch it because it's not worth their time. So they want to see at least a $75,000 loan amount, and that's after taking into consideration your down payment. So the minimum amount that they will lend after your down payment is considered is $75,000. So as much as I would love to be able to do a bunch of these, hood houses, fix them up and then do the BRRRR method, just doesn't work with these types of lenders. Okay, so will hard money lenders give loans for wholesaling? No, that's not really what you want for wholesaling, Joy. I have a different connect for that. What you want for wholesaling is, and I'm assuming that you're talking about for a double close. So if you've got to close on the property and then your buyer is also going to be closing on the same day, what you want is transactional funding. And I've got the plug for that too. And remind me to talk about transactional funding and I'll give you more detail. I just don't want to confuse people with that right now. I'll talk about it at the end. Yep. Okay. All right. So, and then the look back is basically the time frame that they would go back to consider your experience. So 5 years is the time frame that they're going to look back. So if you've got, 5 flips within the past 5 years, you're considered an experienced investor and you'll only have that 10% down payment. Okay. Let's see. What else? They will do new construction, but they only do it in very limited states because this is actually still relatively new for this lender, but they will do new construction in Georgia, Florida, and North Carolina. So if you fix and flip in any of those areas or are thinking about getting into new construction, we can actually get you a new construction loan in those areas. And this lender lends in 30 states for fix and flip loans. All right, you can do a cash out refi up to 65% of the value. So if you've got a property that is worth $100,000, you can get up to 65% on a cash out. Indiana, Not for new construction, but we do lend in Indiana for fix and flip. Yep. All right, we talked about minimum. So minimum value of the property in as-is condition is something that they also look at. They want to only lend on properties that are worth a minimum of $50,000. Again, you know, they are not too keen on these smaller deals. So $50,000 in as-is condition, and they will lend up to $75,000 or a minimum of $75,000, considering your purchase and your renovation budget. The other question that I get a lot is, I know you're running my personal credit, but is it a personal guarantee since you're funding this under my business name? And yes, all of their loans are full recourse, which means that you have to personally guarantee the loan. So bottom line is, if your business doesn't pay the loan, you are personally responsible for it. The one thing that I absolutely love about this lender, and this is unique, I don't see this with any other lenders that I've run across, but they will do a deferred payment program. So what does that mean? So again, this is a 12-month term loan, right? So typically with a lender, it's just like if you were purchasing a primary residence, you close, and typically your first mortgage payment is going to be due 45 to maybe 60 days later. This lender actually does deferred loan payments. So you don't make any payments during the 12 months term on that loan. Okay. But they do accrue your interest, and then that interest comes due when the term of the loan comes due. So the thing that's great about that is when you are doing a fix and flip, and again, you got to come out of pocket to get your project started, that's money that you got to have set aside, and you have to plan to be able to make your mortgage payments. With this lender, you don't. So while you're fixing up the property, you're not having to have the stress and burden of paying a mortgage while you've got money coming out of pocket to actually get the work done. So they will, again, accrue that, and then that will come due when you sell the property or refinance out of the loan. The other question that I get about that is there a prepayment penalty? So again, it's a 12-month term, but let's just say you finish your project in 3 months. Well, they're going to charge you a minimum of 3 months interest anyway. So if you finished it in 1 month, you're going to pay for 3 months of interest. But if you finish it at 6 months, you're only going to pay for the 6 months of interest that has accrued up to that point. So there's no prepayment penalty, but you will pay a minimum of 3 months of interest that has accrued, regardless of whether you sell it the next month or not. Okay. The other thing that is really special about this lender is they will allow you to roll your origination points and your closing costs into the term of into the total of the loan. So you can roll it into your loan what am I trying to say? Balance. So you're not having to pay your closing costs and your origination fee when you close on the property. Just come with your down payment. You can roll that other stuff into the loan amount. Hopefully that makes sense. Okay. They will let you have up to 4 active loans at a time. So if you have multiple projects going on, and as long as you don't have more than 4, you're good. And that's pretty much about it. So we talked about, and you got to have an appraisal. So they will order an appraisal to confirm what the as-is value of the property is, as well as the ARV. And that's about it. This lender can typically close Depends on volume. They've been extremely busy, but they can typically close in 3 to 4 weeks. Usually the holdup is just getting the appraisal done. The appraisers are so busy right now. But after appraisal comes in, assuming that all the other documentation that we've talked about has already been submitted, they can close it in like 10 days from then. All right, so I just threw a lot of information at you about funding your fix and flip deals using hard money. What questions do you have? And I'm definitely going to come back to the transactional question. Did all that make sense? Don't y'all hate these pregnant pauses while I'm waiting for y'all to type? It's awkward, but I know I gotta give y'all time. Is the income qualified through personal or business? Joy, they ain't even trying to check for your income. All you got to do is be able to close. So as long as you got your down payment, they're not asking for bank statements. They're not asking for tax returns. None of that. That's why I love hard money. Like I told you, they don't get all in your business like that with this lender. Now, there are some other ones, like when you do, more of the buy and hold loan product, they want to know, where your down payment's coming from. They want you to have 6 months of reserves in your bank account. They getting all in your business for that. For this fix and flip lender, they ain't checking that. Look, they just like, show me the money at closing, as long as you can close. That's why I was telling y'all, like, it's not as hard as you think it is. The hardest thing for most people is two things: finding the right deals where the numbers work. Because again, you got to have something where the ARV is high enough so that they're only going to lend up to 70% of the ARV, bottom line. So you got to find a deal with enough margin in it to accommodate that. And then the other thing is the down payment. And I can tell you how to get your down payment as well. There's ways around that. And this goes on personal credit? Nope. They use your personal credit to qualify you. The only time that you might see something on your personal credit is if you default on that loan. And I'm sure it'll show up as a collection or charge off at that point. They don't report to your personal credit. They don't even report to your business credit. I'm telling you, it's a beautiful thing. Is it hard to fix and flip with such a demand for houses right now? Again, like the hardest thing is just getting inventory, getting good deals, right? So, and when you say is the hardest, is it hard to fix and flip? Are you talking about finding deals? Are you talking about getting contractors? Or what specifically are you talking about, Joy? Yeah. That's the hard part because people know what they have. It's supply and demand. When you've got people who typically would have been more motivated to sell, and sell at a below market price. A few years ago, that wouldn't have been an issue. A couple years ago, probably wouldn't have been a problem to find deals. But now, people know, they can put I'm in Atlanta. Like, y'all, if you saw some of the stuff, that we see on MLS, you talking about a house, the wind blow hard, the whole thing gonna collapse, and they got a $200,000 price tag on it. So I mean, it's the nature of the market right now. It's bananas. Like, I hear real estate agents and brokers talking all the time about they got to go to war for their clients to try to get their offers accepted. I mean, people are bidding crazy, like 40,000 over the asking price, knowing that it ain't going to praise for that, but they doing what they can to go ahead and get the contract, and then they can come back and renegotiate with the seller after the appraisal comes back to say, this is not appraising, I can't get my loan. And some of these sellers are like, so come with more money down. But it's a crazy market right now. So the deals are a lot harder to come by, but I'm going to tell you where you should be looking for deals. It ain't on MLS. You need to get to know the wholesalers in your area. You need to network at your local RIAs and meetups. I mean, you might find somebody with a real estate agent with a pocket listing. Like, it's all happening behind the scenes, not on MLS. Okay, let me see, Diane. Very interested. I'm just arriving home. Will you explain the wholesale buying process? Let me come back to that because I'm really focused on fix and flip right now. I'm not talking about wholesale. I wanted people to understand how can you fund your deals for fix and flips. Wholesaling is like a whole different kind. We might have to do another live for that one. That's like a whole different can of worms to open. Don't want to confuse people. All right, so any other questions about hard money loans? Yeah, I'll do another live, Diane. Maybe, I don't know, maybe I said I wanted to do Talk to Me Thursdays. So that might be our topic for next Thursday. You know, if I put a time frame on it, that means I got to do these lives. So y'all know this has been a struggle for me, but I guess I'm committed now since I done put it in the universe. Okay, so yes, we connected with the local wholesaler. They send deals via text and they fly like girl, yes. Attend the networking events too. So yeah, you want to have the people who are direct to the seller. So make sure that if you are getting deals from wholesalers, I don't know how it is in other markets, but Atlanta is really bad for what we call daisy chain deals. So what is that? Let's just say I have a contract with the seller and my contract says that I can get that house for $75,000. Well, somebody might see me post the deal and they take my, like without my approval or whatever, they may take my pictures, take the whole copy and paste my whole little, write up in my post and then market themselves like it's their deal. And instead of it being $75,000, now it's $90,000. And then somebody else will see their post. They mark it up. Now it's $100,000. This deal done went from $75,000 to $100,000 because you've got all these wholesalers trying to get in the middle of your deal. So make sure when you are talking to wholesalers, ask them if they are direct to the seller, right? Because you don't want somebody who, and if they say, oh, well, my partner has the contract. Nope. I need to see something with your name or your business name on it, not your partner, because I'm telling you, they slick. And what's going to end up happening is it just muddies the water when you got 3 other people involved in this deal that are that far away from the seller. It's messy. So make sure they're direct to the seller. If you obtain a tax lien property, can you apply for a hard money loan to fix and flip it after you own it? Yeah, so if you own a property, can you get a renovation loan? I guess that's what you're asking. Exactly, Emily. It's bananas. It's so grimy in these wholesale real estate investing streets here in Atlanta. It's a mess. Joy, if you can clarify that for me. So if you own a property, can you get a renovation loan? Is that your question? Yes. Yes, so you can get a renovation only loan if you own the property. What they would be basing it off of is the appraised value of the property. So, and it's as is condition, not after repair value. So they're gonna say if you own that property and that property's worth $75,000, right? They're only gonna lend up to, was it 65% is what I said? Yeah, up to 65% of that value. So you can get a renovation loan. Okay. What other questions y'all got? Y'all want to hear how you can get your down payment money? Okay, with the fix and flip, I missed out on the resources you gave, lenders, business credit. No, we're talking specifically about hard money loans for the fix and flip. I'm going to break down how you can get your down payment money now. Yes, absolutely. Okay. All right. So, as a new investor, you're going to need a 20% down payment. It gets smaller as you get more experienced. If you need funding for your down payment, there's several ways that you can get those funds. Number one, if you got savings, great. If you have a W-2 and you've got a 401k, use your 401k money is lazy money. We don't allow lazy money sitting around here. You can borrow from your 401k and use that for your down payment. If you don't have a 401k or IRA or any other retirement account that you can pull from, you can leverage private money. So what is private money? If you network with other real estate investors, or maybe even you have somebody in your family that has lazy money sitting around that is, collecting 1% a year, tell them, hey, I've got an investment opportunity for you. I'm just looking for private investors to help me fund the deal. Are you willing to invest with me? And, cut them a deal for 10%, 12%, 15%, whatever you can agree to. But typically we pay our private investors between 12 and 15%. But, they may lend you $20,000 or whatever you need to try to get the project going, or you can have multiple private investors. Maybe each one has $5,000. All you need is a promissory note. Again, Google promissory note template. Work up, whatever your terms of your agreement are. And let them know that, you're getting this project done in 6 months or whatever that time frame is, and agree to pay them that percentage when your project is done. You may or may not have people that are in position to do that, but you won't know until you ask. Again, networking with different real estate investors at your local RIA. You have a lot of people that really don't want to manage the projects. They don't want to have to deal with contractors, but they want to invest in real estate. They may be willing to invest with you for the right terms. Okay. So that's private money. And then if you really just don't have anybody who can help you out with funding the project, if you've got good personal credit, you can get business funding using your good personal credit to qualify for the loan. So what does that mean? These are business credit lines that you can, and it won't report on your personal credit if you get the right business credit lines. And the ones that we go after to help people with funding, they don't report on your personal credit. They may report on your business credit, or they may not report at all. But the idea is to get it under the business name so that it doesn't report on your personal credit, and you can, pull cash off of those cards. So you can do cash advances or balance transfers, whatever you need to do to turn that credit into cash, and it not impact the utilization on your personal credit, right? because it doesn't report to your personal credit. So that is another way that you can get funds for your down payment. If your credit isn't 700 or better, and there's some other criteria that they like to see, like low utilization, low inquiries, at least one major credit card, those kinds of things, and even if you don't have all of that, if you got a 680 but you got good W-2 income, still might be able to get you some business funding. There's so many different ways to obtain funding. Like if you don't have good credit, but you've got a business that is generating cash flow, e-commerce, if you've got a business where like service business, like beauty salons, where if you've got consistent deposits in your business bank account, and when I say consistent, like 10,000 or better per month, get your funding based upon your business cash flow if you don't have a W-2 income. If you've got collateral, we can do collateral-based lending. So if you own equipment or own real estate and you need to leverage what you have, we can do a collateral-based loan where they will let the value of your collateral secure your loan for you. I just gave y'all like 5 different ways, at least, to get your down payment. Did all that make sense? I like them hearts. Thank you, Joy. Any other questions about that? And seriously, y'all, like, this is what I do. I try to help people figure out how to tap into all the different sources that are available. We put together a game plan and we execute. So if you're really serious about doing this, I can share my calendar link with you and we can set up some time to talk about your goals and try to help you figure out how to tap into the money, because it's out there. You just need to be strategic in the way that you're going about it. But at the end of the day, you just got to have a profitable project that is going to allow you to make some money. They're looking for ways to lend. They just need projects. Okay. Any other questions about that before I talk about transactional funding? Because I don't want to leave that question sitting out there. Wow, have we seriously been on here? What has this been, like 45 minutes already? Any final questions about that? Okay, Diane, I'll drop it in the chat after the live is done, so you'll have a link to my calendar. Okay, let's talk about transactional funding, because that question did come up about how do you fund wholesale deals. So I can't really go into all the details of the wholesaling process, but for those of you that aren't really familiar with what that is, wholesaling is if you are like, you basically are the middleman. You're finding people who need to sell their properties and getting that property under contract, and you're finding buyers who want to buy properties like that. So if you have, that's why I was saying, if your desire is to fix and flip, get to know the wholesalers, because they got the deals, right? They're the ones that are negotiating these contracts and getting them so that they can then market them to you as the end buyer. So how does the wholesaler get paid? If they get it under contract for $50,000 and you're willing to pay $60,000 for that property, they just made $10,000. That's how that works. Okay. So are you paying a fee for that contract? Absolutely. But if it's a good deal, it's still a good deal. There's still enough room for you to make money with that property. All right. That's wholesaling. But what I just described was what we call an assignment of contract. So they get it under contract for $50,000, and then they can assign their contract to you for $60,000. So that means they have a $10,000 assignment fee. That is acceptable in most states. Some don't allow assignment. You need to know your own state laws. But here in Georgia, it's acceptable. In Alabama, it's acceptable. So know what your laws are where you live. Okay? But typically, a seller won't get too mad at you for making $10,000. But if you got a deal, if you got a deal where you're making a large assignment fee, you might not want that seller to know what you're making, right? We had a $30,000 assignment contract. I ain't want that seller to know I was making $30,000 when he was selling me that house for $56,000. So in order to avoid a situation, you can do a double close, which was what I think it was Joy asking that question. You can do a double closing. So the seller can't see your assignment fee and the buyer can't see your assignment fee. All right. So when you double close, that means that you got to have the $50,000 to buy the property on the first transaction. And then you can turn around and sell it to the end buyer for $60,000. But those are two separate transactions, and there has to be money in the middle to close that deal. Okay. So some closing attorneys will allow you to use that end buyer because you're closing all of this on the same day. Some will allow you to use that end buyer $60,000 to fund both transactions. Some won't. You need to know, based upon your closing attorney's policies, whether or not that's acceptable. It took us 3 different closing attorneys that we went through before we found one that would do it that way. So you need to know whether or not your closing attorney will allow that. If they won't allow that and you got to have the funds to be able to buy that property knowing that you're going to turn around and sell it in another transaction in the same day, that's where transactional funding comes into play. These are like very, very short-term loans, like that day. They don't want to extend it any further than that because they want their money back. You will pay a fee to access those funds, but typically that fee can be anywhere from I've seen right around 1.5 up to about 3%. The transactional funder that I work with will lend up to $400,000 at 1.5%. Okay. So what does that mean? If you have a deal where, like this one that we just described, and if it's less than, a certain amount, she charges a flat fee of $750. I think if it's less than $55,000, there's a flat fee of $750 for those transactions, right? But if you have a scenario like what we just discussed, you're making $10,000. That $750 would come out of the $10,000 that you're making on that deal. Okay. So is it worth it to make $9,250? Probably, especially if you can't come up with the money yourself. But again, I wouldn't do a double close unless I absolutely had to, for something less than $10,000 or really less than $20,000. $20,000 is like my cutoff. If I'm making $20,000 or more, I want to double close because I don't want them looking at me crazy because of what I'm making on the transaction if I'm wholesaling. Did that answer your question, Joy? I think that was you who asked that. Are the requirements still the same for this lending as well? Actually, no. They're not going to be, analyzing every piece of like the ARV and all of that. She will want to know what your purchase price is. She wants to have a copy of the purchase and sale agreement, your LLC paperwork and all of that. But these are super, super easy deals to do. She just wants to know who she's lending to just in case, something goes crazy with the deal. But she doesn't need all those same qualifications like the lender's going to have. for the hard money loan, for transactional funding, because it's a 1-day deal, right? So yeah, that's not, it's nothing. Lots of hearts. All right. Was this helpful, y'all? Did this answer the questions that you had about fix and flip investing? Did it take some of the fear out of how you going to come up with the money to fund your deals? Drop the sauce. That's right, baby. Where the money reside. So what I'm trying to do is really get more, number one, more ladies involved in fix and flip investing. And I mean, we don't have to have the fear of doing this, because you've got so many resources out there. You just need somebody to help you tap into what's out there. That's why I do what I do. Going to try to go all in soon. Let's do it. Let's do it. All right. Well, I've kept y'all damn near an hour now, but this was good. I wanted to share some information with y'all. I will also drop the link to my website. If you have deals that you want funding for, it'll have the application on there and all of the criteria that we talked about that you would need to have. It'll have those guidelines and a checklist, so you can start gathering all of your documents and that kind of stuff together. Yeah, it's not that complicated. It's just, getting all of that that we just talked about, getting it together. But they ain't trying to be all in your business with your income and all of that. That's usually what scares people out there. Like, oh, I don't want to have to come up with tax returns and have them all in my checking account information. They don't care, just as long as you got the money to close. All right, y'all. This was good. We'll pick up next Thursday and talk about wholesaling by special request by Miss Diane. All right. Well, hope y'all have a good night. See you soon. Bye.